Hello and welcome to Market Watch for the end of the week that started on the 23rd of October 2017. And what a week it has been. CPI was everything that I expected it to be in terms of if you're looking at the RBA and therefore pricing around rates, looking to invest around rates, it clearly is giving you an example that the RBA is out of the market. Really did highlight this with the economic view, so please have a look at that video with Tony. But CPI, you can't go past it. It is just not materializing. And what the number you've got to look at the trim mean numbers. I put out a chart at the start of the week and around that idea that if you look at it, it is trending lower. It's almost a linear decline in terms of a 45-degree angle. And on Wednesday, the numbers clearly showed you that if you stripped out housing, inflation is so flat that it'd actually be more likely between 0.2 and 0.5 year on year rather than the 1.8 that we actually got. It also shows that if you look in things like consumption, if you look at things also just general going outs, they're also now in contraction as well. They're in deflationary markets. And that would therefore scare the RBA because consumption is a core part of GDP. And if you've started to sort of see a decline on price, a decline on usage, all that filters through. And it's a really bad perpetuating cycle as well, because if you've got low growth, which unfortunately we do, and we therefore have low wages, which filters from that, which we do, it therefore means that we get lower prices and we don't get any form of movement on that side either. And it's a self-fulfilling cycle, and it's therefore a real downward spiral, which is the uncertain side. Have a look at this chart. This is the Aussie dollar for this year, and if you have a look at that trend line, it is now broken to the downside. So there is a positive out of this because the RBA is out. We know that the US Fed is likely to raise rates in December and could even do it 3 times according to them in 2018, more likely 1.5. The Aussie is going to be lower. So there is a possible inflation movement there with the fact that those that are exposed to exports, those that actually involve themselves in international markets, get a tailwind from the Aussie dollar being lower. It also means that just general exports, things like tourism, things like also education, and then you can even look into things like production that we have, big areas, things, food, wine, alcohol, etc. are big parts of what we do, are getting a better buck with that Aussie lower. So that breakdown's very interesting. It could therefore head towards 75, even as low as 74 cents would make the RBA happy. But in the main, the CPI is telling you that their core mandate of 2 to 3% is not being met and is unlikely to be met anytime soon. Then having a look at the purchase prices index that came out on Friday, that too is illustrating that even purchasers are seeing prices on the downside. It came in below expectations quarter on quarter at 0.2 of 1% versus 0.4, and then year on year it's also very flat. So all of that just gets back down into that cycle. And it's a big move this month. This week has really reiterated what I believe. 2018 is going to be a little bit of a headwind. Inflation's nowhere to be seen. The RBA is out. But there are positives. Growth in jobs is there. Growth in economic activity is also there. What I want to hopefully see is whether or not you can translate it through. And this week just reiterated that unfortunately it just isn't happening. And therefore, with that in mind, it probably will be a choppy 2018, and that probably needs to thinking into probably your investments. It's why bank earnings season at the moment is also quite interesting. So huge week this week. I'll be certainly highlighting it over the next couple of months as well, because I think it really does give you a good macro base to what 2018 will look like and what that therefore means from an investment point of view and also from a growth point of view.